All right, we'll see how well this works. See if my voice holds out while I do this. So we're going to talk a little bit about, go over a little bit more of the information I talked about in the lecture dealing with joint cost. So we'll kind of skip through the objectives here. But I want to highlight a couple things. One, issues of definition that the textbook uses. And these definitions will also show up in the questions that you're going to be asked for quizzes and homework, and obviously for the exam. Joint costs are anything that happen up to the split out point. And generally, those would be all of your production cost. That is, direct materials, direct labor, manufacturing overhead would be included in that. And the big question with joint cost is how much of those joint costs go into each of the products that are produced. Now, the split out point is the point at which these products all arise. And generally, with joint cost production, the idea is that these products arise more or less simultaneously. So, for example, if I'm processing wheat, okay, then my various products that I'm going to produce from that are going to arise more or less at the same time. With oil, the same thing. The gas, the kerosene, the tar, the gas, everything are going to arise at the same time. So the question is, how much of those production costs do I allocate to each of those products? Separable costs are different. These only arise beyond the split up point, and only if you decide to process the product further, or as I say sometimes, to enhance it, to make it better, to increase the sales price. Now, generally, I don't try to make a huge issue out of this major product. We'll talk about mostly products versus byproducts. A product is anything that generally has some sort of positive sales value. Now, some products have no, in fact, it actually can have a negative value in the sense that you have to pay to get rid of it. Hazardous materials would be a good example of that. Okay. Now, a product would have now the products that you produce that have a positive sales value can run the gamut in terms of having a very high sales value to a very low sales value. But it's up to the company to decide how they want to. All right, now. Now, a main product is, by definition, something that has a relatively high sales value compared to others. Joint products are all those things which arise at the same time at the split-off point. A byproduct is, by very definition, something that's sort of immaterial in terms of its sales value. And in many cases, the company is just sort of happy to recover whatever the cost might be. And, or, if nothing else, somebody, well, how do we dispose of it in the least cost method? And again, here are some examples of the types of industries, and it's a fairly extensive list. Joint production costs are fairly common in many instances. Okay, so why do I allocate joint costs? Well, number one, because GAAP requires it. GAAP says you must allocate all production cost to all of your products that you produce that are so that you can then match those against the revenues. Now, if a product doesn't really generate any sort of revenue, then I'm under no obligation to allocate joint cost to it. The other big thing would be litigation. That is, if a product is lost or stolen, damaged, how much did it cost? I can file a claim against the insurance company, or I have standing in court to say, hey, this is the value of the product that was destroyed. Now, in terms of how you go about allocating joint cost, there are generally going to be two methods. One, sort of based on some sort of sales value of the product, sometimes called ability to bear or market-based, and the other is physical measures. And so we'll take a look at these examples as we go through here. All right, we'll look at a relatively simple example where the joint costs are $400,000, and the input is the 110,000 gallons of milk. And in this case, we have two outputs, cream, liquid skim, and relative amounts of each of these. As I said the other day, you can kind of see, oh, if I'm going to allocate this based on some sort of physical measures, In this case, they have a common physical measure. Now, in many cases, that's not going to be the case. In the oil industry, for example, gas and kerosene will be measured in barrels. The butane, that sort of natural gas, would be measured in cubic yards, and maybe tar, heavy oil might be measured in terms of tons. So it becomes very difficult to often do that. So in this case, with physical measures, 25, 75 gives you 100,000 total output. It would be a 25-75% split to allocate the joint cost. It is a measure that can be used, but it's not as common. Now, the assumption here we're going to look at here, that the joint costs are 400,000. The production is 25 and 75, but the sales are 20 and 30. So my objective here is to allocate the joint cost so that I have a proper valuation of ending inventory and a proper valuation of cost of goods sold. And likewise, at the split-off point, okay, the products can be sold for, in this case, cream can be sold for $8 per gallon, and the liquid skim can be sold for $4. The sales value at the split-off point is often considered the most objective because you know what the market value is. Anything that happens beyond the split-off point, you may have good information about, but it's not quite as solid in terms of information. The split-off method, the sales value to split-off method, is probably the most common, but again, it also assumes that you're not going to process the item any further, that you cannot do anything with it, so you simply have to sell it as is. It is objective, but in most cases, companies will often process something further to enhance the sales value to make more money on it. Now, in this particular case, using the sales value to split off point, that if you take the 25 times 8, the 75 times 4, here are the two relative sales values, 200,000 and 300,000. So you have a total of 500,000 of total sales value. So 2 over 5, 3 over 5 gives you a 40-60 split. 40% of 400,000 is 160. 60% of that is 240. Then, again, if you want to do it this way, I tend to do it this way myself, but you're under no obligation to do that, to take the 160, the total cost, because that's all the costs that are going to be here, and divide it by 25, take the 240,000 divided by 75, and you come up with this cost per gallon. That can be used to value ending inventory and to value the cost of goods sold. Now, panel A and panel B are two separate calculations. A is the allocation of cost. B is calculating is basically creating the income statement. Again, pull down now sales are going to be different than production. Costs are always going to be allocated based on total production. Now, when I go to prepare the income statement, I need to allocate those total costs, the 160 and 240, between what's in inventory at the end versus what got sold or cost of goods sold. Okay. So the total production, okay, in this case, revenues are 160. The total cost allocated is 160. 5,000 gallons in ending inventory, valued at 32,000. Therefore, cost of goods sold is 128,000. And so my gross margin here is 32,000. Do the same thing over here for liquid skim. Calculate the gross margin of 24,000. Now, in this case, it's strictly accidental that both of the products have the same gross margin. That was not the intent. But, all right, physical measures, as I said, 25-75% split. 100,000 goes to cream, 75,000 or 300,000 goes to liquid skim, and divided by the total production, and you get these costs per unit. Again, sort of accidental that they both have the same cost per unit. And then pull down the sales are going to be the same no matter which method I use. Here are my total production costs, since I'm not doing any further processing. With 5,000 gallons in ending inventory, I would value ending inventory at 20,000. It gives me 80,000 cost of goods sold. or excuse me, cost of goods sold of 80,000. Okay, so if I subtract 80 from the 100,000 or 160,000, excuse me, I end up with 80,000. Okay. Now, again, sometimes with physical measures, you can see this, you can throw a lot of cost at a product and you can move it to, in this case, zero gross margin. In fact, sometimes you can even move it to a negative gross margin. So that's one of the real challenges with, or one of the real problems with the physical measures. You can end up with results that really don't really help you to make decisions. Okay, now the net realizable value method makes a basic assumption that you're going to process the products further, that in addition to the joint cost, that the product is going to incur additional incremental or called separable cost to enhance the sales value. And in fact, in many cases, you actually change the nature of the product. But I would only do this if my NRV here is greater than what I would make at the split off point. All right, now again, kind of the same basic information, except that we're going to look at two additional items here. And that is that, for example, with the cream, they're going to process it further into a new product, okay, buttercream. But in order to do that, it costs $280,000. Likewise, with the liquid skim, they're going to process it further at a cost of $520,000, end up with a different product, condensed milk. Yeah, you lose some volume along the way. That's inevitable in many products, okay? But it doesn't necessarily mean that you're going to lose money. If the enhanced sales value is sufficient, you can certainly make that up. All right, so the joint costs are $400,000. The separable costs are only applied to the individual product, okay? In other words, buttercream is only going to be allocated $280, condensed milk, $520, but the joint costs are going to be shared across both of these products here, okay? Now, again, the same basic information, but here we have the buttercream production of 20,000, 50,000 here, at a sales price of 25 for the buttercream, 22,000 for the condensed milk, and you have the not only the production, but the sales, 12 and 8 for buttercream, 45 and 5 for the condensed milk. All right, now net realizable value. Well, the first thing is to say, look, okay, how much are we going to make if we take the total production of condensed milk and buttercream? Okay, how much will we make? Well, you know, you're going to have 20,000 gallons of buttercream at $25 per gallon, 50,000 gallons of condensed milk at $22. So you have the 1.6 million. Now, the total separable cost here are the sum of 280 and 520. Okay, so the total net realizable value is 800,000, and that is beyond a split off point. I can sell the buttercream for 500,000, but it's going to cost me 280, so I net out at 220. That's what I'm going to make. I do the same thing with condensed milk. Okay, so if these are my two net realizable values, 220 and 580, okay, you know, 800,000, then take the proportions, 27.5, 72.5, and divide up the joint cost. Yeah, the 110 and 290. Now, what they do over here, and this is important, it's kind of hidden, but it's real important. They're saying that the 1950 is not just the joint cost. This is the 220 and the 110, and I'm going to divide it by the 20,000. Okay, the 1620 is the 580 and the 290 divided by the 50,000 gallons. So my cost per unit is a sum of my total cost, joint and separable, okay, and divided by my total production. Now again, revenues are a function of sales. That's going to be a little bit different. They sell, you know, the 12,000 gallons of the buttercream, the 45,000 gallons of condensed milk, and they generate this amount of sales, 1.2 $2 million. Now the joint cost, same thing, $400,000, but we've allocated $110 and $290 to the two products. Then we allocate the separable cost because those are applicable to that particular. So you have a total production cost, $390 and $810. Okay. Then you apportion that. Say if this is my total production cost, subtract out my ending inventory. Okay, this is my cost of goods sold, $234 for buttercream and $729 for condensed milk. So you end up with a gross margin of 66 and 261. And you can see in this case there is a substantial difference in the gross margin. Okay, constant gross margin method is a kind of a strange creature, but what it's attempting to do is to take the two different products that we have here, and you're going to guarantee that each product will end up with the same gross margin. Now, the joint cost that I allocate may be different, but each product will have the same gross margin. In a sense, why? Because we don't want to penalize the product or the manager for this arbitrary allocation of joint cost. So the first step is to determine the gross margin of the company as a whole. So if the company were to sell all of its products, okay, 1.6 million is what they would get. Total cost are 1.2 million. Gross margin would be 400,000 or 25%. All right, now what we do is we go back and look at the individual products. And let's say we look at, for example, buttercream. Okay, its total revenues that it could generate given this production is $500,000. Well, the constant gross margin method is really a series of subtractions. The first is to subtract out the gross margin. We're going to guarantee them the 25%. So of that 500,000, we're going to allocate. What's going to be left is basically the joint cost we're going to allocate. So we have the 125, the gross margin, kind of working our way upwards from the income statement. So the 375 represent my total cost. So if I say here's 375, my total cost, subtract out the separable cost of 280, what I'm left with is the 95,000. Okay, that's going to be the joint cost allocation. Okay. Now, panel B is just creating the income statement. So assuming again 12,000 at $25 per gallon, 300,000. Okay, the total cost we know 375. And if I allocate that 375 between ending inventory, cost of goods sold, I end up with this gross margin of $75,000. Again, a 25% gross margin for the product. Okay, I neglected to say that if I go back up to the 375, which is what they're doing down here, the 375, if I divide it by the total production of 20,000, my cost per unit is $18.75. So I can allocate that, the $18.75 times 5,000 would give me my ending inventory, or 20,000 times 1875 would give me my cost of goods sold. I end up with a gross margin. So you could do it on a proportional basis, you know, the 80%, 20%, or you could do it on a per unit basis, whichever way is easier for you to do. All right, I'll finish out this part of the discussion by talking in terms of the sale process further. And I'm kind of skipping backwards a little bit. Now, the question, do I sell it as is or do I process it further, is going to be based on maximizing my profit. Now, in the case of buttercream, going back to the original information, I know that if I sell it as is at the split point, I can generate $200,000. That's it. There are no, and again, I'm not even going to include any discussion at all about joint costs because they're irrelevant. Once they've been incurred, they become irrelevant. Now, I want to take this number and compare it with that, okay? And that is that if I process the buttercream further, I will generate $500,000 of revenue, move it to $25 per gallon, but I have to incur the separable cost. So my net realizable value is $220. Now it's marginally better, but it's better by $20,000. Likewise, make this same comparison. At the split off point, I can sell the condensed milk for 300,000. But if I process it further, I can make 580. So in both cases, I would be better off processing it further. Now, I'm under no obligation. Let's say that the separable cost here were 320,000. Well, that would take me below 200,000 if that were the case. And so if that were the case, I would not process it further. I'm under absolutely no obligation to process a product further. I only want to do that if the total net realizable value will be greater than what I could get for it at the split up point. All right, byproducts. Byproducts are something that occur not on purpose, but as sort of an accident of production. So if you're going to process wood, trees into lumber, you're going to end up with wood chips. You're going to end up with sawdust. Byproducts are not the intent of my production process. The question is, what do I do with them? Now, in the case of wood chips, there is a little bit of a market for it. And in this case, we're going to assume that what we can get for it is the cost. Now, if we go back here, notice that they produce 4,000 cubic feet of wood chips. Now, the assumption is that you can get $1 per cubic foot. Okay, that's what we're going to assume. So my sales price for the wood chips is more or less, we'll assume that's going to be the cost. Now, there are two different methods I can use to account for byproducts. The simplest method is to simply add it as additional revenue. Okay, if I sell 1,200 cubic feet of wood chips at $1 per cubic foot, just add it to my overall sales revenue, and everything else is more or less the same. That's what's called the sales method. It's fairly simple. Now, the other option I have is to reach into my total production cost. And under the production method, what I'm essentially going to do, I'm going to create an inventory called wood chips, so that I'm going to pull out a work in process by making a credit entry of $4,000 and a debit entry to wood chip inventory. We'll call it that. So every time I sell the wood chips, okay, I'm going to debit cash and credit wood chips. So now what that means is that my total manufacturing costs are going to be slightly different in the amount of $250 under the sales method, $246 over here. So my cost of goods sold in any inventory for my good product are going to be somewhat different. Now, generally speaking, the production method tends to give you a little bit higher gross margin percentage. So that's one of the incentives for doing it. Most companies say, well, yeah, that's great. Byproducts are really so immaterial. We're not going to worry about it. We're going to throw it into sales method. There is no right or wrong answer as long as there's a good accounting for it. As I said, the issue with byproducts is not so much whether I use a sales method or production method, but I want to have a good accounting for cash. The internal control over cash is paramount here, and it may not seem like a lot, but cumulative over several years, the theft of cash can be significant.